Well, welcome, test takers. This is Dean Tenney coming to you from my studio here in fabulous Las Vegas. The best paid supplement or best free supplement to your paid study materials is the YouTube channel that you're watching presently. But a very great paid supplement, in fact, my favorite would be a Kaplan QBank. A Kaplan QBank, if you don't have it, with my Guru 10 discount code at checkout, I think you can get it for about $60. I would also recommend the Kaplan Quick Sheets for the 65, very helpful as well. That's $19, 10% off. It's about $17. For that commercial, Kaplan allows me to give you free look on Kaplan content. So what we're doing is one of the favorite things of people who view the channel, subscribe to the channel, is a explicated practice final. So what you should do is hit pause, try and answer, then see how I answered, and we'll score it up, and we'll see how we did, yours truly and yourself. Explications is a fancy word for more than explaining it. It's more about, the answers and why they're right and why they're wrong. Now, this is going to be a very long one. These explications can be very long, 130 questions. So I'm going to set my timer here for 30 minutes. And maybe, you want to take a break along the way, take a pause, hit pause and come back to it when you're getting tired. So here's our first one. An agent of a broker-dealer who willfully violates the Uniform Securities Act may be subject to which of the following? Civil liabilities? Yes. Criminal penalties? Yes. Action taken by the administrator to deny, suspend, or revoke the agent's registration? Absolutely. 1, 2, and 3. If an agent fails to inform a client that a company whose security he is selling is changing the investment managers of its employees' pension plan under the Uniform Securities Act, this omission. So very important for you as a test taker about omissions of material facts. A material fact is something that might alter an investor's decision. An immaterial fact is something I can omit. I am allowed to make kind of editorial decisions about, what to tell you or not. Now, what I can't do is omit material facts. Material fact is, again, something to alter your decision. I saw this investment advisor representative being interviewed. He was asked why he didn't tell the client the information. He said, I thought I'd lose the sale. That would be material. Here, this isn't material, so I'm going to say no violation. I'm trying to make the screen as big as possible. And I'm trying to read the questions and a little slower and tell you what the answers are. Just because people have told me that they're listening. I think that's kind of hard to listen to a explicated practice final, but and I know you might be using your mobile phone. So hopefully this is as big as I can blow it up and still show the answer set. Number 3 here is very much something you should be prepared to answer on the test. The yield to maturity of a bond represents or most resembles, or you should say, the internal rate of return. A is the right answer there. That is very much, a test question, right? It takes into consideration the future value and the net present value. So don't tell me it's the net present value. That's a number. It's the rate of return. It's the rate of return. All right, so let's see, number 4. A client seeks diversification through real estate is concerned about illiquidity associated with investing in real estate. Which of the following investments would be most suitable? You should definitely know that partnerships are not liquid. You can't get in or out of a partnership without the permission of the general partner. And so that is not true of a REIT. You don't need permission of a general partner to sell your REIT to someone else. And most of them trade, and for test purposes, all of them trade in the secondary market. So it'd be buying and selling like a stock, T+2. And remember, REITs and mutual funds must pass through at least 90% of their net investment income, whereas partnerships pass through both profits and losses. So I'm going to say D, a REIT. Which of the following is not true of the Securities Act of 1934? Sometimes you get questions right by saying, are they asking about paper prospectuses, or are they asking about people and places? You can cover up the screen and see what that's about. I don't know why people want to think that arbitrage is somehow a problem. Arbitrage is not. Arbitrage is simply profiting from price discrepancies. That's perfectly legal. There's a crypto guy who's named SBF, and I saw him being interviewed. They asked how he became a billionaire, and he said he was arbitraging cryptocurrencies. He was shorting them on the market where they were high, the market crypto exchange where they're high, and shorting them and buying them low, right? So he's doing a long and a short sale. Nothing wrong with arbitrage, right? It's not market manipulation. The Act prescribes the use of wash trades. Yeah, wash trades are where there's no effective change in ownership. And the idea there is you're trying to give the false impression of volume. Definitely a problem. Spreading rumors, again, is a form of market manipulation. Definitely a problem. Creating the appearance of trading again, giving the false impression of volume is definitely a problem. In the old days, that classical painting the tape is giving the false impression of volume. So I'm going to say A on that one. Which of the following circumstances would it be most likely be presumed that an investment advisor holds custody of a client's property? Now, remember, the point on this is if I'm a state-covered investment advisor and have custody, my net worth is going to be 35 grand. And if I'm not, my net worth is going to be 10 grand. So this can be kind of an issue. All right, so let's look at our choices here. I'm going to have to shrink the screen a little bit so we can, I'm trying to make it as large as possible for you, but I got to be able to see the answer sets. There we go. Can we get them all in there? There we can. So which of the following circumstances would it most likely be presumed that an advisor holds custody of client property? Paul is a client of Gibraltar Advisors, although he makes deposits to his investment accounts by checks payable to Delta Securities. So it sounds like Delta Securities is the person who has custody. That's very typical, by the way, for an investment advisory firm to use a broker-dealer for execution and custody. Checks for his semi-annual financial pleas are made payable to Gibraltar Advisors. Now, that doesn't look like custody to me. Let's see what our other choices are. I think Delta is the one that has custody there. B, Harold, a client, makes a check intended for his investment account payable Gibraltar Advisors, which is duly registered as an investment advisor and a broker-dealer. Harold's fee is automatically withdrawn from his account on a semi-annual basis. Well, here it looks like there's an affiliated relationship here between Gibraltar Advisors and the broker-dealer, right? That looks like it's going to be custody. Let's look and see. Ellen engages Sam, a representative of a registered investment advisor, to prepare a financial plan. In conjunction with the plan preparation, Ellen provides Sam with access to her brokerage account. Again, it looks like the brokerage account has custody. Carol gives her investment advisor associate a check made payable to the custodian. Given this answer set, I think B is our best answer, right? Where there's a relationship, this is typically going to be you with a 76365 is what that situation looks like. So I'm going to say B. An individual who's passed the NASA examination for registration as an investment advisor, woohoo, that's you, right? 65. I mean, that's the whole point of why you're doing this. May begin soliciting advisory clients when informed by the administrator that the registration is effective. That sounds pretty good. When informed by the firm, now it's not the firm that decides that. Within 48 hours, immediately. So I have to decide now as an investment advisor representative if I'm going to be hearing. It's the administrator that does it, but the administrator is not going to inform you. The person who's going to inform you is your firm, right? So I'm going to say B. Even though be careful, don't fall for the trick of saying it's when you pass your test. It's when your registration becomes effective. And again, very important word. We don't use the word approve. We don't use the word guarantee. Those are nasty words. Effective is the word we use. It doesn't mean anything other than that. It's effective. So I'm going to say B on that one. Which of the following transactions in ABC stock would be considered a block trade? I don't think this is at all something you need to worry about on your exam. You're 65. I would know that the New York Stock Exchange is an auction order driven market, whereas NASDAQ is an over-the-counter negotiated quote driven market. Definitely would know that. I would know that trades in listed securities, ABC in this example, done off the floor, are third market trades. And I would know that direct trading between institutions is the fourth market. By definition, this is 10,000 shares. And typically we're going to do that off the chain for the exchange and then report the trade. A significant increase in the importing of goods into the United States would have likely which effect on the strength of the dollar? You are going to get some dollar questions about dollar going up, dollar going down in terms of economics. You know, the biggest difference between a 65 and a 66 is 65 has some economics questions on it. So it seems like if we are buying more stuff, which of the significant increase importing goods, I always try to give it some tangible. So I'm buying more tequila, right? Would have what effect on the strength of US dollar? So if all these dollars are now leaving the US and going overseas, there's going to be more of them. If there are more of them, more supply of these dollars overseas, we would expect the dollar to weaken. Now, I think the thing you're going to see on your exam is not so much this type of a question, but knowing what happens to the balance of trade when the dollar goes up or down, right? So when the dollar weakens, U.S. exports become more competitive and imports become less competitive. When the U.S. dollar strengthens, U.S. exports become less competitive and U.S. imports become more competitive. So you'll get a question, but I just don't think it's going to be this one. ADRs, guaranteed test question. I don't know of any 65 exam where you're not going to get a question about ADRs. There are 2 test questions about ADRs. The 2 questions about the ADRs is this one, the domestic trading of foreign securities. And then remember the other one is going to be if the underlying business, if you're buying an ADR in Telefonos de Mexico or Samsung or Toyota or Nestle, you have currency risk because you're going to have to turn the Swiss francs or the Mexican pesos or the yuan or the yen into dollars, right? So those are the 2 questions. So make sure you can answer that because you're going to get that. That is very much a test question. The chief analyst at your firm, suggests that some of the investment advisor representatives, I always like to spell out, you know, the acronym. So every time I hear the word investment advisor rep, I'm going to say, ooh, that's me, right? And that's what you're trying to get to some client's portfolio. Among the benefits of doing so, you are going to get something like this, and it's diversification, right? The other thing you should be prepared for in your 65 is the diversification we're looking for here is negative correlation. We're hoping these emerging market asset allocation we're making in your portfolio has a different correlation to the, you know, U.S. Equity market. So D. One of the major financial decisions made by a family is the amount and the type of insurance that they need. If I'm not an insurance guy, and I was telling my friend, I said, you need some insurance. And if I'm the one telling you needs life insurance, you really need it. So he goes, well, Dean, I don't want to make a bet with an insurance company. I got to die to collect. I said, Jim, it's not about you. It's about your wife and your kids. Anyways, the form of insurance that offers flexible premiums without a fixed cash value is universal life. You know, whole life is a traditional insurance policy. Term life is a traditional insurance policy. And then, you know, here it's a universal life. 1 or 2 insurance questions. If you tell me you missed the 65 because of insurance, I'm going to say I don't really believe you. You know, there had to be some bigger problems there. Under NASA's statement of policy of unethical, dishonest business practices of broker dealers and agents. So, you know, 65 assumes that you may or may not, you know, work at a broker dealer. Some people are taking 65s are just working for fee-based investment advisors. But I would imagine that most of you listening to this video are actually maybe have a Series 6 or 7, and you're an agent of a broker dealer. By the way, this is a lot of area of test questions. You know, you don't get lots of questions in certain areas. That's what I think makes the 65 challenging, is you get 2 Z's and 3 Z's, you know, but this is more. This is 5, 7, 8. This could be as many as 10 questions on dishonest business practices. Don't lie, cheat, or steal. Which of the following is not considered when determining excessive trading? So that's called churning. Churning are trades that are excessive in size and frequency and more about earning commissions than they are, helping your client. The client's financial status, yes. The character of the account, yes. The length of association with the agent, no, that's not really something that has to do with churning. I kind of think that's the odd man out. Investment objectives of the clients, absolutely. So I'm going to go for C. A registered investment advisor advertised they're offering a free 6-month subscription. So far, I'm saying, well, it doesn't look like any compensation. One of the key things you want to be looking for on your exam is there compensation involved? Now, if there's no compensation involved, that could be an issue, whether there is or isn't. So I'm just filing that away for future reference. Which of the following qualifiers is acceptable under NASA, North American Security Administrator Association's model rule on unethical business practices of investment advisors, investment advisor reps, and federally covered advisors? Your free subscription will start once you have furnished us with names, addresses, and 3-year firms. You're not allowed to not make good on a free offer, at no cost or obligation. If you offer something to somebody at no cost or obligation, it has indeed to be at no cost or obligation. So which of the following qualifiers is acceptable? So that's not acceptable. Your free subscription will be start upon the receipt of your completed financial profile. No. C, your free subscription will start once we've received your name and mailing or email address. Yeah, I mean, to send this to you, I have to have that information. That sounds reasonable. We'll start with your third trade. No. I don't like this particular question, but the content, the takeaway is very testable. If you offer something to a client or prospect at no cost or obligation, it has to indeed be at no cost or obligation, and you have to have the intent to deliver. You have to have the intent to deliver. Sally is an agent with a broker-dealer. She has used her degree in computer science to develop her own stock picking software program. Oh boy. The program creates a model portfolio with a 70-30 ratio of equity to debt securities. Back testing has shown the program is likely to produce returns that beat the overall market. As a result, Sally plans to use this model portfolio for each of her clients. This sounds like to me, test point, a blanket recommendation. And, usually everybody's situation would be unique. And so I think it's going to be a problem. Now, there are situations where this would not be a violation. If I, for example, am somebody who tells you I'm a growth guy, all I do is growth stocks. And so if you sign up with me, I'm going to be doing growth stocks. If that's my specialty, there's nothing in here that she has any kind of a specialty. She's going to make her clients very happy. We should have been able to get rid of that right out of the gate. I don't know this. Nothing in this question suggests that she's unethical. She must make the details of how the program works available to all who request it. Is likely violating suitability requirements. Yeah, usually, right? I like the phraseology, likely violating suitability requirements. And what this is about on your exam is a blanket recommendations. So in most circumstances, blanket recommendations are going to be likely lead to a problem with suitability. So I would say for you, I say, listen, everybody's situation is unique. And so I need to find out about you before I start making recommendations to you. Right. Sally, we did that one. When comparing a active to passive real estate, the primary benefit is, now, again, I don't know if it'll be real estate, but there is definitely going to be questions about, the advantages to passive and active management, good things and bad things about each. So the primary benefit of active, that means you're actually going to engage in real estate yourself, is control. Yeah, that sounds pretty good. Smaller capital commitment. No, if you're going to actively invest in real estate, you're going to have a larger capital commitment than if you do it in a pooled situation like a REIT or a partnership or something like that. You should definitely know real estate doesn't have liquidity unless it's a REIT, right? I mean, you can't call your real estate agent and say, sell my house and send me a check in T+2. No. Lower risk? No, you have actually higher risk. So don't really like this question. I think the questions you're going to get on the test is not about real estate. It's going to be about passive and active managements of securities. But, oh well. Got my video feed in the way here. I think a lot of candidates get hung up on quantitative analysis. If you tell me that you, didn't pass your exam because of the capital asset pricing model, I'm going to say I really don't believe you. But, whatever you're not comfortable with, you're going to swear you had 130 of them. The capital asset pricing model is most commonly used to determine an investor's expected return. So I highly recommend you make a flashcard and turn these kind of questions into aim and shoot, point and click questions, recognition questions. It's not going to be the risk adjusted return. No, it's not the holding period return. It's not time weighted. It's the expected return. An investment advisor would be able to enter into an advisory contract with all the following except. So one of these persons in this question, I'm not going to be able to do business with. A philanthropy, not a problem. 3 brothers in a joint account, not a problem. We do not open accounts for minors directly. The only account we have for minors are Uniform Transfer to Minors Act or Uniform Gift to Minors Act. I can't imagine you're not going to get questions on the Uniform Transfer to Minors Act or Uniform Gift to Minors Act. You need to know 1 custodian, 1 minor per account. The kid's tax ID number goes on the account and no margin. So, minors are not persons or can't be held legally accountable. So C. You have a 62-year-old client who opened a Roth IRA with your firm 1 year ago. They put $6,500 in there. So remember, a Roth, you're using after-tax money. That's $6,500 that you've already paid taxes on. And the account's value is now $7,500. The client has another Roth opened 8 years ago at another firm. The client would like to withdraw $7,000 from this account rather than one of the other firm. It doesn't matter here. The tax consequences, remember, will be no tax here. Remember, now the other one, we didn't have it, right? So it depends on how long, you've had it. It has to be there 5 years. So that's why the one is not going to be a problem and the other would be. So there's no tax there. Roth are going to be on your test. I don't think you're going to see something this complicated. I think what you're going to get asked about is not this question, but rather knowing there's no RMD, no required minimum distributions. Under federal law, an application for becoming an associated person of a broker-dealer would be denied. So what this question is about is reasons for statutory disqualification. There are situations in which you cannot be, you can be disqualified by statute. Pleading no under federal law, by the way, federal law, this is about the Uniform Securities Act. An application, remember the Uniform Securities Act is the template for the states. So we're not talking about that here. An application for becoming an associated person would be denied for an individual. I think I would have done reverse here Sesame Street trick, process of elimination. Pleading no contest to a misdemeanor involving a financial matter 65 months ago. Now, this is Kaplan just being a jerk. I divide that by 12 to figure out how many years that is. The test is not going to do that to you. I should have been able to eliminate, you have to be a citizen. Convicted of a felony 122 months ago, accused of a securities-related felony 110 months ago. And so what this question is getting at is this idea of 10 years, right? So 10 years would be 120 months, so again, I think this is kind of a stupid question. The answer is A. Kaplan, they're trying to stretch your mind, hope it doesn't go back to the same spot. I sometimes just call them gotcha questions, You just need to know what are reasons for statutory disqualification on your exam. All the following statements regarding futures contracts are correct, except. So purchasing a contract for future delivery is considered taking a long position. Yes. The only two positions you have in futures is long futures and short futures. You're either buying the futures or you're selling the futures. So purchasing means you're going long, and that means you think the price of the futures is going up. So A is true. Futures contracts can be written on financial assets or commodities. Indeed, we have futures on agricultural products like corn and soybeans, and financial things like the S&P 500. That's true. A short position will increase if the underlying commodity or asset declines in value. That's true, just like any other short position. Completing the futures contract requires the delivery of the commodity. Now, you can close it out. You don't have to take delivery. You're going to get a couple questions on futures, and futures are derivatives like options. And you're just going to do in the futures market, if you're using them to speculate, it's pretty simple. You go long if you think it's going up, and you go short if you think it's going down. And if you're using the hedge, you do in the futures market today, whatever you're going to do in the cash market later on, right? So if for example, my soybean example, if I'm a soybean farmer, if I'm, afraid of the price going which direction, I'm afraid when I take the beans out of the field, they're going to go down. So I would short the futures, right? I sell the soybean futures. I'm going to be selling soybeans when I get my harvest in. And I'm hoping that if, the soybeans are at a lower price, my short positions will offset some of that. If I'm, making soy sauce, I'm Kikomin, I'm afraid the price of soybeans are going to go up. So I'd go long. I've been thinking about making a little video, but I just don't think it's, there's not enough performance opportunities to, do it. Zero coupon bonds, definitely on the exam. Zero coupon bonds are definitely on your exam. I can't imagine any draw in which you are not going to get asked about zero coupon bonds. Investor purchases zero coupon bonds issued by U.S. Treasury, so no credit risk, due to mature in 18 years at $100,000. Which of the following might describe the primary reason for selecting this investment vehicle? This is very testable. The investor is 65 years old and needs the reliability of current income. Oh my God, you should flunk the entire exam if you say that. Zero coupon means zero income. There is no income. So boy, one is a really, really bad miss. Two, the investor is 45 years old. And I'm seeing 18 years. That sounds pretty good. It purchased these in an IRA rollover account. So that's pretty cool because the imputed interest, the accretion, is not going to be taxable. And once the assurance of funds, yeah, I mean, the U.S. Treasury, there's no better credit quality. Two sounds pretty good. So I need two. So I can get rid of, I like to shop my answer set. So I'm looking for two. I got rid of one, so I need two without one in it. Two without one in it. So I say, oh, if I need two without one, it looks like I got to take 2 and 3. So three, the investor is 30 years old and has a newborn child and wishes to assure the funds are funds for college education. Absolutely. I tell a story in my lecture that, I show up at a baby shower and say, hey, when the kid's 20 years old, I got some money for him. Don't have it today. So 2 and 3, that is very much a test question. You're going to encounter 2 or 3 questions about zeros on your exam. Consent to service. So now it looks like we had a couple ones where I said, oh man, that's a poor question. But now we're getting some ones that are definitely high probability in terms of the test. You definitely need to know about the consent to service and what it is. It allows the state administrator to receive legal documents. If I'm trying to serve you legal papers, I can't find you, I serve the state administrator, and you're considered served. It's a permanent part of your record. And so, you don't redo it all the time. It's just when you come into the business, it's going to be on your original application of the business that you're saying, I give the state administrator permission to receive legal documents on my behalf. Which of the following concerning hedge funds are true? Purchasers of hedge funds are generally required to be accredited investors. That's true. Hedge funds are organized as private placements. And remember, private placements under 33 are a safe harbor and exemption, right? Reg D. And that means you have to have $1 million net worth, exclusive of your primary residence, or $200,000 in annual income with the expectation of $200,000 in income this year, or married and filing jointly $300,000 for the last 2 years with the expectation of $300,000 this year, or no hedge fund for you. I'm joking, but not really. I definitely would know that. A good way to remember that is 1, 2, 3. Now, be careful. It only means on this exam you're 65 that you can accept an invitation to a private placement. It doesn't mean anything other than that. So be careful that you don't try and make that sound something different. Now, good news for you, when you pass your 65 and you're in good standing, that means you're associated with an investment advisory firm, you too will be an accredited investor. Anyway, so that one is true. Two, short sales by the fund are not allowed. No, the whole point of a hedge fund is so we can make all kinds of crazy aggressive investments that wouldn't be allowed if we're a mutual fund. The whole point of a hedge fund is to avoid the Investment Company Act of 1940. So we most certainly can do short sales. In fact, there's a guy who, had a $1 billion short position and lost $1 billion because it went up. When you hear somebody losing $300, $400, $500 million, it's usually a hedge fund because they're employing all kinds of, leveraged, aggressive investment techniques. It is not uncommon for there to be a lockup period. Yep. Again, it's a partnership, so you can't get in or out without the hedge fund. The hedge fund manager is the general partner, and you can't get in or out without his permission. He might say, hey, the gate is closed right now. So that's true. It's unusual. No, the fund managers have a big ownership in the fund. In fact, usually they're the largest investors in the fund. The New York Mets, the guy who owns them is a guy named Stevie Cohen, and he has a hedge fund called Point 72, and he is the single largest investor in that fund. That's my 30-minute timer telling me we've been at it 30 minutes. So I'm going to reset that. If you want to take a little break, you can do so. And like I say, these explications, I understand people still like them. They find them helpful. And, so I'm going to do them. They're long. And I can't tell you how much work it is for me because I got to timestamp them. So I've been putting this one off because it's 130 questions and it just, takes a long time. Anyways, we're going to say 1 and 3 on that one. A risk-averse investor has only invested in CDs. Wow. So they haven't even made the first climb up the risk ladder, which is to be able to accept investment risk. So haven't even done that yet. Let's see. Was informed by his investment advisor representative, that higher returns with safety could be achieved by investing in U.S. Treasury notes with a 10-year maturity. The advisor representative assured his client that the investment in federal government-backed securities is riskless. Not true. You have interest rate risk, right? If you're in a Treasury note and interest rates go up, which they're presently doing, the Treasury security is going to go down. Now, maybe you're not going to participate in the secondary market, but by the way, that sentence there, the advisor assured his clients it's riskless. That makes the whole question a problem. So, when you're reading these paragraphs and everything sounds cool except one thing, then that means nothing's cool in the question, right? Now, T-bills wouldn't have that. Property, because T-bills carry no risk of principal default. That's true. But remember, we're dealing with the sentence that says they're riskless. Properly, because Treasury notes are suitable for risk-averse customers. That's true, but that's not, what that sentence is about. Unethically, because the Treasury notes are not suitable for risk-averse investors. No, they're suitable for risk-averse investors. D, unethical because the agent failed. Yeah, there we go. D is in dog. Under NASA's model rule, but this model rule comes up a lot. You might want to Google the model rule and just read it. I mean, why not? I mean, I told you it's target rich in terms of performance opportunities, test questions, right? Under NASA's model rule of unethical business practices of investment advisors, investment advisor representatives, and federally covered advisors, the contract between an investment advisor and the clients must be in written form. Boom. By the way, make sure you understand too, you can't assign the investment advisory contract without the consent of the customer. Under the Uniform Securities Act, again, I always like to spell out the acronyms. On the Uniform Securities Act, which of the following would be grounds for suspension, denial, and revoking of an issuer's registration statement? Information in the registration statement is complete. Yes. Unreasonable compensation to the underwriters. Yes. Failure to pay your filing fees. Yes. The security is subject to an administrative stop order in federal court. Yes. 1, 2, 3, and 4. 1, 2, 3, and 4. Which of the following is does not benefit both the employer and the employee? Which of the following? So we're looking for something that it looks like three of these things in the question are going to benefit both of them, and one is going to benefit one but not the other. All right. So which of the following does not benefit both the employee and the employer? A traditional IRA sounds pretty good because remember, traditional IRA, it's you that's responsible for that. That has nothing to do with your employer. A simplified employee pension plan, that has to do with your employer. A simplified employee retirement plan has something to do with your employer. A defined benefit plan comes from your employer. So using the Sesame Street trick, one of these things is not like the other. We're going to go for a traditional IRA because that's just about you, individual retirement account. Which of the items would change if the company declared a cash dividend? I've been thinking about doing a lecture just on balance sheets, but again, it's kind of like that one I told you I was thinking about futures. Then sometimes it feeds the psychosis that it's really a big deal, and it's not. It's not. That being said, on 65, you do have to have a general understanding of the classical balance sheet equation, which is assets minus liabilities equals net worth. You should definitely know that current assets minus current liabilities is working capital. And when you declare a dividend, it becomes a current liability. So if current liabilities go up and current assets remain the same, that means that working capital is indeed affected. So I need something with one. The asset side of the balance sheet hasn't changed. As I just said, I have the same amount of current and fixed assets as I did before they declared the dividend. As I said, the liabilities go up. And shareholder equity, that's where it's coming from, because when we have earnings available to common, we're going to either keep some of that as retained earnings, and the other is going to be the distribution, the dividend. So this is 1, 3, and 4. You should know working capital. You should know current ratio, current assets divided by current liabilities. You should know the quick or acid test ratio, which is quick assets. That's the current assets less the inventory divided by current liabilities. Ratio is always division. You should know debt to total capital. So, I would recognize that an answer said. My point being, I don't think you're going to see this one, but you will see a balance sheet question of some sort. Which of the following statements regarding investment risk is not correct? Not correct. A stock's level of risk is a combination of market risk and diversifiable risk. Yeah, that is true, right? Systematic risk is the tendency of securities prices to move together. Risks in the system. So I don't care what stock you have. I think it is when, bad things happen to good stocks. The market goes down 30%, your stock probably went down too, as well as your mutual fund. Systematic risk may be reduced or eliminated by effective portfolio diversification. Which of the following investment risk is not correct? That is not correct. I don't like the phraseology here, but you can't diversify away systematic risk, right? You can diversify non-systematic risk known as selection risk. But the way they say this on your exam is risk prevails despite your diversification. Now, we can try under modern portfolio theory to get something that, has negative correlation, and that would diversify the portfolio, but we can't eliminate a systematic risk. C, the beta coefficient is individual stocks. It measures an individual stock's relative volatility to the market. Not correct. That is correct. Remember, we're asking, well, you got to be careful on what not correct. That is correct. That is what beta is. It's measured. The market, by the way, is the S&P 500 for beta purposes. Investors earn a higher rate of return for assuming higher. Yeah. So B is not true. Risk prevails despite diversification. You should know that cash dividends are a taxable event, and stock dividends are not. So this is not a taxable event. So as your broker, I'm not going to do a math on the screen because this is already going to come in, an hour plus. But anyways, I'm going to take 100 times 25%. So I'll play broker. Hey, Julie, we just got a 25% stock dividend. So you have 25 more shares. So now you have 125 shares. You have more shares, so does everybody else. So you have the same proportioned ownership. You bought 100 shares at 25, your cost base is still $2,500, but now you have 125 shares. And I hope you remember me telling you this in this question. A lot of times, like this one, you can just shop your answer set. I need something with more shares at a lower cost, which is 1 and 4, right? So I got 125 shares and my cost base is 20. By the way, I would just take the 2,500, divide by 125. I think you're going to be tested on stock dividends, stock splits not being a taxable event. When Julie sells, her adjusted cost base will determine what's going on, right? She sells for more than 20 or less than 20, her adjusted cost base. Cost basis is just when she turned the money into the stock, right? So here's 100 shares at 25. That's her cost basis. And then she hopes someday to turn the stock back into money, and she's hoping she's going to have more. Eurodollars. The key word is dollar. So we have Eurodollar bonds and we have Euro bonds. So these are typically US dollars that aren't in the US. European currency held in US banks. No, those would be euros. Obsolete currency that was formally backed by the gold standard. A worldwide currency system that is expected to know. Yeah, and American dollars held by banks in other countries. Right now, the dollar has been strengthening, and so that's causing a major impact in other areas of the world. So these are American dollars held in banks in other countries, and they're just exchanging the dollars with each other rather than coming into the U.S. to do it. So the answer is D. Now, you might get on the test a Eurodollar bond, same thing, be a European issuer, but they're agreeing to pay you interest and principal in dollars. So you would have currency risk. Euro bond would be a bond that is denominated in euros, and you would have foreign currency risk. A client to 25 years to retirement. So time horizon is always very important when making investments. And so when we're making investments, it's going to be very important, that time horizon. So I think I'm going to probably want to use, again, the Sesame Street trick. One of these things is not like the other. And I think with that kind of a time horizon, you can mess up substantially, again, suitability questions, because they're always judgment questions. The 3 styles of questions you get are recognition, practical application, and judgment questions. And so this is a judgment question. I see preferred stocks. I think, fixed income doesn't sound like it's going to work for us. Common stocks, tried and true. I think I like common stocks. A private placement, nah. There's nothing in here about accreditation or, what this is a private placement about. Bonds, no. I think I'm going to go with common stock, tried and true. Boom. An agent for a broker-dealer receives a buy order from an investment advisory firm on behalf of its clients. The order is to purchase 5,000 shares of XYZ common stock at the market. The advisor informs the agent that once the purchase is complete, the account numbers and quantities for each individual client will be supplied. The buy is completed, but at various prices. How is the order allocated to the advisor's account? So first in, first out. So what we're looking for here is what is the fairest way for us to internally now allocate this to our various investment advisory clients. And I think first in, first out is going to be kind of discriminatory, right? First in, first out is the right answer in situations, but let's see what other answers are available to us. The order is reallocated the investment advisor's account by using the average cost basis. I think that's fair. That sounds pretty reasonable, right? I simply divide and, figure out that sounds good. The most favorable, no. We're not supposed to be discriminatory amongst our clients. So no, the trade cannot be accepted. No, it looks like our best choice here is fairest, most reasonable would be to use the average cost. When a bond's net present value is 0. So here we are at question 35. And again, I just want to warn you again that don't obsess about quantitative analysis. Mostly it's recognizing inputs and outputs, not so much can you do any kind of a math. So when a bond's net present value is 0, that means It's neither a good deal nor a bad deal. There is no, value proposition to that. If its market's got a price with the net present value being zero, that means the market's pretty efficient, right? Misprice would be, positive or negative net present value, right? So the market is highly efficient. Again, I don't think you're going to have to deal with that much, but defensive stocks are companies that deliver products and services resilient to the business cycle. And regardless of the business cycle, you got to eat. Some people think tobacco stocks are countercyclical, that people smoke and drink even more. Utilities, nobody wants to go back to the Stone Age, but you can delay purchasing steel. So food, tobacco, and utilities are defensive. That is testable. Note what is a defensive stock. And steel is going to be cyclical, right? You can delay purchasing steel. That's cyclical. When times are good, they're really, really good. But when they're bad, they're really, really bad. The mode. So remember, the mode is the number that appears the most often. I think the one you're going to have to be able to do on the test is the median, just a simple average, right? So we just go through this, and if we know the mode is the one that appears most often, and it's looking, I'm just shopping it here, and it looks like 5%, that's twice. 5%, that's 3 times. I don't see any other one that has more than 2, so I'm going to say 5%. Now, I would be prepared on your exam to total all those numbers up, 1, 2, 3, 4, 5, 6, 7, 8, the set of numbers, which is 9, divide by 9, and then give me a simple average on the test. An investor originally purchased a debt security at par. We definitely par for bonds is 1,000, and par for preferred is 100. Unfortunately, the value has now fallen to 920, so it's trading at a discount. Even though the companies reported record earnings, who cares? So the earnings, as a creditor, I don't really care about your earnings. I hope you can pay me, but the decline in value would represent. So very testable. When anybody ever asks you about economics, finance, or investments, you want to sound smart, you should say it has a lot to do with interest rates. And they say, what about them? You say, well, they fluctuate. They say, is that good news or bad news? You say, well, it depends. Can you tell me more? Right? So when interest rates go up, the bond price is going to go down. And so that's going to be interest rate risk. Potential investment company clients should be advised to investigate a fund by looking at which of the following. Mutual funds have a very good custodial history. So when you hear somebody losing a lot of money, it's usually with an investment advisory firm in terms of lack of custody and not a mutual fund because of custody. So you would want to look at the investment policy, certainly, Roman number 1. The number of shares outstanding, what does that matter? I mean, that really has nothing to do with it. As I told you, you don't need to worry about the custodial bank and whether it's State Street or JP Morgan, who cares? The portfolio, yes. So I'm going to say 1 and 4, right? The number of shares outstanding. And by the way, it means you misunderstand a mutual fund because the number of shares, the NAV isn't dependent on people coming in and out. It's not going to change the NAV per share. Definition of inflation. Inflation is too much money chasing too few goods. Deflation is too many goods and not enough money. And you're definitely going to get tested on monetary policy. That's the money supply controlled by the Federal Reserve Board. And so, this is the fancy definition of inflation. I'm an old-fashioned guy. I like to carry around a lot of cash here in Las Vegas, and a decrease in the value of my monetary unit. Yeah, when I pull out my money clip, it doesn't buy me what it used to. You should definitely know that the Fed is the one who's charged with price stability or price equilibrium. And you should know they do that through interest rates, open market operations of the Fed. Right now, I'm coming to you at a time when the Fed is fighting inflation. They're raising interest rates. They are selling government securities, the open market committee. And when they sell the securities, the money supply contracts and interest rates go up. You should definitely have a general understanding of the discount rate set directly by the Fed, the Fed funds rate, most volatile of the rates, banks with excess reserves, charging the banks with deficient reserves, broker call, what banks charge brokerage firms, and used to finance margin accounts, and prime banks to its best commercial customers. So it's definitely going to be testable. In order to be in compliance with the rules, an investment advisor would have to disclose to the firm when the firm was acting in a principal capacity. So very testable. We have dealer principal capacity and we have broker agency capacity. And when we're acting in our dealer principal capacity, that's a bigger conflict of interest because I'm not trading with a third party on your behalf. I'm trading directly with you. I am the other side of the trade, my firm, right? So in order to be in compliance with the rules, an investment advisor would have to disclose that the firm was acting in a principal capacity when I'm the other side of the trade, right? So A is I'm the other side of the trade. I'm buying shares out of your account for my own proprietary interests. You know, the idea there is, and the test you got to believe in human gravity, original sin, that I want to give you the lowest price possible, right? It's not about trades done with our officers partners now. Engaging in an agency cross. An agency cross is where I'm crossing two customers. I'm dual agency. I'm representing the buyer and the seller, but I'm not charging a markup or markdown. Directing securities transaction, that happens all the time. So it's A. Capacity is very testable. So I don't know when you're taking this, but make sure you spend some time on, broker dealers, brokers, ABC, agent, broker, commission. That's a broker dealer that's acting in its broker capacity, and dealer principals transactions, we're charging markups and markdowns. Now, the investment, that was about an investment advisor, but even at the broker dealer, that would be disclosed. And we disclose it all the time on the confirm. We can never be a broker and a dealer in the same trade. On retirement, if your customer who is a corporate executive will receive a retirement income equaling a percentage of their base pay, that sounds like a defined benefit plan to me. Not many companies hand out that old-fashioned defined benefit plan anymore because, the employer is assuming the investment risk. The employer is assuming the investment risk. KEOs would be for self-employed individuals. If you're a senator, we'll come up with the idea, we name it after you. So Senator Roth, Senator Keogh, that's for self-employed. Tax shelter annuities, very testable. That's for employees of educational establishments, 403Bs, or employees of nonprofits. Defined contribution is a employer plan, but it's not a percentage of your base pay. There, the employee is assuming the investment risk. An investment advisory firm advertises a stock picking system that helps investors choose the timing and selection of their securities for purchase. Under the Investment Advisor Act of 1940, which of the following must be disclosed? Which of the following must be disclosed? The number of years the system has been used successfully. I don't know. 2, the difficulty of using the system. I should definitely know that. So I need 2. The limitations of the system. Yeah, definitely. So I got to have 2 and 3. And that means I only can take these. So I didn't have to burn up brain cells on Roman numeral 1. An advisory client of yours discusses a business project she's involved in where the partnership is using depreciation, accelerated depreciation. So depreciation is a non-cash expense. You don't get to use assets for free. And so we're going to charge those assets for their use because we know eventually we're going to have to replace those assets. So, the two types of charging the assets for its use is straight line depreciation and accelerated depreciation. Accelerated depreciation, we get it off our balance sheet a little quicker, but it also generates bigger losses. And remember, the losses are not real losses because it's a non-cash expense. It would be prudent of you to inform the client. Now, the 3,000, I kind of like that. 3,000 about portfolio, and this is a partnership. So 3,000 is a number that you can take from your portfolio losses against your ordinary income. So that's out. We're not talking about portfolio. We're talking about passive. We're talking about partnership. So A and B are out. Because whatever happens in your partnership, part of your tax return stays there. So A and B are out, and those losses and profits get passed through. Acceleration depreciation could trigger the alternative minimum tax. Yeah, it can be what we call a preference item. So, if you are, making a couple $100,000, you take all your deductions. I think it's unlikely you're going to see this as a preference item on the AMT. I think it's more likely you're going to see an industrial development revenue bond, a type of municipal bond that supports a private activity. I think that's the more common or higher probability on your exam. Because of the changes in the Secure Act, minimum distributions, we changed that, and it took them forever to actually update the exam. NASA is notoriously, late. in terms of making updates, but it certainly has been updated. And it's now 72, but I have, two choices that say 72. And so it's by April 1st. I wouldn't worry about the April 1st, but you should definitely know it's 72. And then remember, 59.5 is when you can choose to draw down. You can choose to draw down. Individual employed by a broker-dealer to make cold calls to solicit prospects for the firm's new wrap fee account. So a wrap fee is going to require the rep. We don't know anything yet about rep, but you're going to have to be duly registered. I would imagine a lot of you are taking this exam to sell wrap accounts, where we wrap our products and services of our broker-dealer and our investment advisory, affiliated investment advisory, into a fee. And I have to give a wrap brochure. Under the Uniform Securities Act, it's true to state that the individual, it sounds like this person needs to be registered, right? It doesn't say anything about that. This is Dean Tenney calling for so-and-so. It's me cold calling. So not defined because only making cold calls. No, I mean, you're making public contact. Permitted to use the term investment counsel would be defined. Yeah, I think you're going to have to go take your test, right? Baird, a registered agent. I always like to think that's me. So when they say agent, I say, okay, that's me with my 6 or 7. If you're a 65 only, this is somebody who works at a broker dealer. Receives an order from Miller, her customer, for an unusually large order of common stock and XYZ Corporation. He states, he overheard the CFO of XYZ telling his golfing partner, sounds like it's going to be material non-public information, telling his golfing partner that XYZ was close to being acquired and incorporated. In light of ethical standards on the Uniform Securities Act, which of the following actions is most acceptable? Wow. Most acceptable. So Baird, I tell my immediate supervisor, that sounds pretty damn good, right? That sounds good. I like it. Let's see if I don't like anything better. I would say read the full answer set, because who knows? We might find a better answer, but that one sounds pretty good. RTFQ, read the full question. RTFA, read the full answer set. Baird takes Miller's order and does not discuss the conversation she had with Miller. No. See, within the trading day, Baird recommends XYZ. You trade along, you shadow the trades. Absolutely not. You purchase it, you front run and buy it for your own account. No. Given that answer set, A looks like our best answer. Credible Investments is a investment specialist, is a state registered. Now, remember, you're either going to be state or federal, never both. I have a lecture, Who's Your Daddy? So the firm is never going to be registered with both. It's either going to be states or the SEC, right? It only has offices in state A. In which states would registration be required? This is, I like this question. I like this question a lot. State A, where the only clients are large corporations. Well, you're already registered in state A. Right. So, I don't think we need to burn up brain cells on Roman numeral 1, because it says that you have offices in state A. So there's no circumstance in which you're not going to be registered in state A. It has nothing to do with the pension plans. You're going to have to be licensed in state A. State B, where the clients are only banks. So in state B, I have no office and I have no retail clients. So I don't think I'm going to have to register in state B. So I can toss out any answer with a 2 in it. 3, state C. Again, I have no place of business and no retail clients. The state administrator is all about protecting retail clients. So I need something without 2 and without 3. State D, where there are 6 or fewer. Now, remember, de minimis, 6 or fewer is 5 or less, right? So if you have more than 5, you've lost the de minimis. So it's going to be 1 and 4. A portfolio manager who routinely shifts portfolio assets to take advantage of the business cycle. Oh boy, I'll tell you, this is kind of aggressive, right? Because you can miss the business cycle. You think it's, the pandemic's ending, and then it doesn't, right? I know a lot of, funds that were doing this, and they were rotating in and out based on the pandemic, and they missed it a couple times, and that can hurt. That's called sector rotation by definition. Sector rotation. That's an aim and shoot, point and click kind of a test question. An investor purchases 100 shares of Capco at 50 At the time of the purchase, the stock pays a quarterly dividend of 25 cents. The dividend increases 5% each year over the next 5 years. The purchaser sells the 100 shares for after purchase for 82. What is the total return? Now, in the interest of time, I'm not going to do this question because I'm trying to bring this thing in at an hour and a half. But let me just tell you what we would do if we're going to do it. And you can certainly try it. I'm going to guess B. I'm going to assign it to the universe and we'll see if I got it right. But basically what I'm going to do is turn that 25 cents into a dollar, right? And then that means that 5% the next year is going to be $1.05. And then 5% of $1.05, would be whatever the new dividend is, and 5%, so on and so forth. I'm going to do that, 5 times. That will tell me the total dividend is I've received. And I'm going to sell it for 5 years at 82. So I have 100 shares at $3,200 there. And then I'm going to combine what I received in income and price appreciation. And I'm going to divide by original cost basis, which was 5,000. Maybe in the video description, if you'd like, when I timestamp it, let me know if it's not timestamped when you're watching it, and I'll put the timestamps in the timestamp, the actual math. Under the Investment Advisor Act of 1940, an investment advisor that uses a website would be required. So what is required of an investment advisor's website? Maintain a copy of the screens used would be, there's our second 30 minutes. So again, as we said, we're going to give you 30-minute, if you want to take a 30-minute break. So that means we're at an hour, and it looks like Dean is off my pace. It looks like this is going to be one of our larger, or longer, I should say, videos. I kind of knew it would, because when we're explicating practice finals, it's not aim and shoot, point and click. It's an explication where I like to talk about the question and the right answer. So if you'd like to take a break, now is the time to do so. Hopefully we can get this done in the next 30 minutes. So hope we get a lot of aim and shoot, point and click. Anyways, under the Investment Advisor of 1940, you're going to have a copy of the screens. Yep. Place copies of news screens in the advertising file every time you make a change. Yep. File copies of the web design with the SEC. Password protect. The limit to access. Well, it should be, it depends on whether it's a portal or not. Right. So, there's nothing in there that tells me there's a portal into a customer account. It sounds like we're using it for advertising. So I'm going to say 1 and 2. A broker-dealer publishes a list of securities for inclusion in individual retirement accounts. This means, it sounds like there's probably going to be something about like recommendation. Are we making a recommendation? The broker-dealer has evaluated these securities and believes they would be suitable for inclusion for retirement planning. That sounds awful good. Let's see what our next choice is. An agent for the broker-dealer can place these in clients' IRAs, knowing the suitability requirements have been met. No. Right? Because remember, you're supposed to be doing that based on each individual unique client situation. So A sounds good, B doesn't sound so great. The broker-dealer is committed to unethical business practice because the use of the word approved, I think they're using the word approved here is internal. I don't think we're telling the customer that this is approved. As I said, that's a nasty word, but here we're using it internally. I don't think there's anything in the question that suggests I told the customer these are approved for their IRA. It's an internal thing. The broker-dealers consulted the regulatory authorities and received approval, and don't ever say that. D is a really bad miss. I don't really care for the answer set, but given this answer set, I think A is our best answer. This is very much an answer set on the test. Very much something you should do. A, B, C, D, or 1, 2, 3, 4. I can't imagine you're not going to see that answer set. So flow through of income and losses with limited liability. So, they have a question on the exam that actually is about a husband and wife who have a partnership. They're both general partners. And the question asks, why would they want to dissolve their partnership and reorganize as an LLC? And the reason they would want to do that is because in an LLC, you do not have unlimited liability, right? So flow through, we know we're going to have an LLC. So that's which choice, Roman numeral 2. C Corp that has retained earnings, it doesn't flow through. Sole proprietors, the business and the sole proprietor are one and the same. So I need a 2 without 1 and 3. S corps, yeah. S corps are corporations where profits and losses flow through. And so the answer is 2 and 4. I love this answer set. You're going to see this answer set more than once. So make sure you're clear. But if I ask, I could use all the following have flow through of income and expenses except, and then it would be a C corp. I know the maximum shareholders in S corp is 100, and they have to be residents. Very testable. Mark's company is located in Oregon. It makes unfurnished wood furniture. His company sells the furniture directly to the public from a large warehouse. Teresa is located in southern Georgia. She grows cotton for t-shirt manufacturers. Which of the following statements correctly identifies the hedging strategies of Mark and Teresa? I like this. Remember, I told you you're going to do in the futures market today what you're going to do in the cash market later on, right? And what you're afraid about is the opposite market direction, right? So let's look at our friend Mark. Mark is making furniture. So his input is wood, right? So he's worried about the price of lumber going up. And so as we said, he's going to do in the futures market today what he's going to do in the cash market later on. He's going to go long the lumber futures. And he's hoping that when he buys the lumber and that price is higher, his future position is also higher. And the profit from his future position will indeed hedge or offset the risk of the cash market, the spot market. So 1. All right, let's look at Teresa. She's located in Southern California. She grows cotton. So she is selling cotton. So she would be afraid that the price of cotton is going to go down. So she's going to do in the futures market today what she's going to be doing in the cash market, spot market later on, which is selling cotton. So she's going to sell the cotton futures. She's going to go short the cotton futures. So sell means short, by the way. So the answer here is A. I like this. This is a good example of a futures question. I think it's the second one. I told you to see 1 or 2. Here's our second one. So I also like it in terms of weighting of what you're going to see on the exam. In order to compute a client's holding period return, again, this is very much like the exam. A lot of times they don't ask you to do the math. I had a guy, he wasn't using hubris. He said, Dean, I'm a serious math geek. I don't need to memorize any formulas. You know, you give me any 2 numbers, I can solve for the third. I'm a serious math guy, so don't waste my time in this tutoring session, you know, doing math with me. So fine. Good news, he passed me. He said, Dean, they didn't ask me to do the math. And so I was a little, you know, I was able to figure it out, but they asked me just to recognize simply the input or output, not actually do anything. And he struggled a little bit. So in order to compute a client's realized holding return, it's not necessary to know. So again, this is an input. What are you going to need to do it? I'm not going to ask you to do it here. I'm just asking to recognize it. So we're going to need the original investment, certainly. Income received, yeah. Paper losses, no. No, who cares about that? The value at the end. So you need A, B, and C. You don't need to know paper losses. Boom. Holding period return is, you know, how long it took you to make the money. Obviously, 30% sounds good, but not if it took you 50 years to do it. Under which of the following circumstances may attorneys and accountants claim an exclusion? So remember, you should definitely know late. Lawyers, accountants, teachers, and engineers have a carve out or an exclusion from having to register as investment advisors. The key word we're looking for in this circumstance is very much a test term, is incidental. There are key pivot words on the exam, and one of them is incidental. So they charge a separate fee for the provision of investment advice from that received for their professional services. No, if they have a separate fee, and I know attorneys who manage money, they have to set up an investment advisory firm. The advice is incidental. Yeah, I always use the example of like I'm a personal injury attorney. I'm not an attorney, but I say, hey, we just won $100 million. As you know, my contingency is third, so $33 million for me, $67 million for you. And you say, Dean, what should I do with the money? I said, well, you should call my guy and get a variable annuity. I just gave you investment advice. It's incidental, and there was no compensation. Very much a test question. So make sure you look for the word incidental in the answer set. As interest rates rise, the opportunity cost of holding cash. So, if I'm sitting on cash, remember, I'm not getting any kind of a return on the cash. And that would be good, if there was a, deflationary environment. but now I can put my money out to rent. And, always the interest rates are going up. The price of holding my cash increases, right? Because I'm getting nothing. And right now, yields on bonds are going from 3, 4, 5, 6, 7%. So at some point, it would behoove me to, turn my cash into some kind of an investment. Jasper Quartermain is interested in using options to create insurance. So when you say insurance on the test, again, if 65 is tough. I've got hours of option lectures on the channel. I'm not so sure how much you want to do in terms of futures and options to pass your 65. But this answer set is where most of it's at, right? So, hedging, do there's calls and puts, you go long or short for basic option positions. A severe drop in the stock portfolio. So I'm looking for something that would offset the drop in my portfolio. How could he best accomplish this goal? And what is this strategy called? So it looks like what I want to be able to do is have something, again, insurance means I'm going to buy the option. So we should have been able to get rid of C&D right out of the gate. When we see the word insurance, we're buying an option. If we see the word income, we're selling an option. So we're going to do A or B. A drop, what I would like to do is establish the choice to sell my stocks. So I'm going to buy a put, and that's called a protective put. And, if I want to do this for my entire portfolio, I probably wouldn't buy a put in each of the securities I own. I'd probably buy a put on the index that most closely approximates my portfolio. And I would hope, again, when the value goes down, the value of my put goes up. And, I would make some money to offset the loss I've got in my portfolio. One of the goals of modern portfolio theory isn't truth. Theory is just a way of explaining things. And the more a theory can explain, the better that theory is. Right? So modern portfolio theory isn't truth, just a way of explaining things. A constructive portfolio that provides the highest return with the lowest risk is known as the efficient portfolio. The efficient frontier is this portfolio set that would do that. Again, aim and shoot, point and click. Now, the Sharps ratio compares how I got the risk in a portfolio. The higher the Sharp ratio, the better. This one is D. So again, mostly inputs and outputs. Which of the following is required to effectuate? Kaplan's trying to use big words. I lost this argument at, Kaplan. But, people say they encounter bad grammar and big words. So, Kaplan tries to approximate the same thing. And renew a registration of an investment advisor rep affiliated with a federally covered advisor. So, I don't have to register as an investment advisor in any state other than the home state of my investment advisory firm if I'm federally covered. If I'm an investment advisor rep, I only need to register in the state in which my home office is. And then the only other time I'd have to register in a state, doesn't matter how many clients I have, I could have a boatload, is if I have an office in some other state. That's about the individual, the natural person. And so what are you going to have to do? You're going to have to pay the fee. You still have to pay the fee, right? I would know the registrations for persons, both on natural persons and natural persons, on natural persons, natural person. You as an investment advisor are a natural person. You're a living, breathing human being walking planet Earth. And your firm is an unnatural person. It's not a living, breathing human being walking planet Earth. But I would also know those registrations need to be renewed on December 31st. As a client's only child is about to complete her college education, it is obvious that the 529 plan used to accumulate funds has been overfunded. They will ask you about 529s versus Coverdales. That's not this question, but make sure as a test taker, you can do that contrasting question. And almost always on the test, you're supposed to say, what are the advantages of 529 versus a Coverdale? Which of the following might be suggested to minimize the tax? We encourage the daughter to go to graduate school and use the money. Yeah, why not? If money's available, why not make use of it? Sounds good. Roll over the funds to another member of the family. Yeah, that sounds good. Roll over the funds to a Coverdale. Why in the world would you do that? I can't imagine why you would do that. Roll over to your own IRA? Absolutely not. So 1 and 2. I don't think this is the question you'll get on 529, but you'll certainly get something. You'll certainly get something. Each of the following is associated with political risk except. Yeah, well, don't use your own brain housing group against yourself. I'm kind of thinking, personally, I can get guilty of overthinking a question, use my own brain against myself. Now, let's go for the obvious ones first. Coups, absolutely. Nationalization of private industries, yes. Adverse weather conditions, that seems like the odd one out. But, if the weather's bad enough, it could cause problems. And terrorism, absolutely so. You will get a political risk, currency risk, legislative risk. You'll get at least one questions on those things. An investor has just received an inheritance and decided to use the money to buy a new home. Because it will take time to decide where to buy, this is very much a test question. They give you very much the same kind of a question on your exam where, somebody's been relocated, what should they do? It is expected the purchase will not be made for 6 to 9 months. If the investor places money into a broad index ETF, man, I just think that's a terrible idea. On the test, the choice we get is either like CDs or a money market or something that's safe. But boy, did this question take a U-turn. So now it's asking me about what is the risk in an ETF? And it's a broad market ETF. And so that means you're going to have market risk or systematic risk. Definitely be able to contrast an open-end mutual fund with an ETF. How are they different? And make sure you can contrast an ETF to an ETN, exchange traded note. Boy, you should definitely know fiscal policy. Fiscal policy is controlled by Congress and the president. It's government spending and taxation. And monetary policy is controlled by the Federal Reserve Board. Definitely. So C and D are fiscal policy. A is just the wrong one. So B is the test question. Very much a test question. Although new accounts must be approved by a designated supervisor before any trading can take place, there is one type of an account that must be approved by a specially qualified supervisor. These are called registered options principals. And if you're going to be approving options accounts, you need to take them past what's called a Series 4. And, we're going to give them the disclosure document. And I'm going to go back and my ROP is going to say, Dean, did you give them the disclosure document? I say, yes. My registered option principal approves the options account. We then have 15 days to get that back. They read it, they understood it. And, if not, 15 days, then we only allow them to do offsetting or closing transactions. An investor owns a 2 times leveraged inverse ETF. If the index goes down, that would be good. The ETF here is inverse, so it should go up, right? So the fund shares will also decrease? No. The fund shares will increase, yes. And they'll increase by a factor of 2. That's the point of that ETF, right? So inverse means it goes the opposite direction. A client is interested in investing in a mutual fund that will provide current income without the risk of a large swing in the portfolio's value. The client is in a high income tax bracket. So the minute they say on the test, high income tax bracket, it looks like we're going to be shopping for a muni answer. And make sure on the test you can do tax-free and tax equivalent yields. So that part there, tax bracket means munis. Which of the following would be appropriate? So we're going to toss out A and B, and now we got to decide long-term or intermediate. It says without large swings, and you should definitely know that longer-term bonds are more volatile than shorter-term bonds. So because it says large swings, volatility, I'm going to go for the intermediate bond fund because that's going to have lower volatility in terms of the underlying bonds in the portfolio. By the way, debrief on 65. Somebody told me they got a question about the tax consequences of being a municipal bond mutual fund. And remember, the dividends from the mutual fund that owns muni bonds are the pass-through of the interest. So that's the only time the dividends from a mutual fund would be tax-free is if you're in a muni bond mutual fund. And then capital gains are always taxable. So if there's a capital gains distribution, that's going to be taxable. Told you this answer set is going to be there, right? Here, a business organized, I just tell you that's going to be an answer set. and it pays federal income tax. So in S corps and LLCs, partnerships, sole proprietorships, that answer set is definitely on the exam, and they're asking you which one of these is going to be paying taxes on its income. And LLCs, the members that passes through partnerships, it's going to be the S corp. You and the business are one of the same. I just don't like this doesn't have a C corp, but that answer set is definitely on the exam. Oh, I think I missed that. I said the right thing, sole provider, but then I hit the wrong button. Client is considering the purchase of American depository receipts. I told you that's definitely going to be on the test. She's looking to further diversify her portfolio. Which of the following is not a feature of the ADR? So we said the ADR does allow you to diversify internationally, and you're hoping by doing so, right, to get different correlation returns than you would get in the U.S. marketplace. All right, so which of the following is not a feature? Information regarding foreign companies is easily attainable. Well, when you have the ADR, you are going to be able to more easily attain the information. ADRs are dominated in and pay dividends in US dollars. Yeah, well, yeah, but remember, you're still getting those dollars are coming from exchanging the pesos or yen. ADRs are traded on the exchange and OTC markets. That's true. Not a feature. So they are not subject. No, remember we said it's very testable. No, they are subject to the exchange rate or currency risk. I don't really care about ABC here, but you should definitely know D. You should. And so the distractors are the technical name for wrong answers. I wouldn't worry too much about the wrong answers. But make sure you know the D is definitely a part of an ADR. An agent of a broker-dealer in Illinois terminates their employment to accept a new position with a broker-dealer. So that's important. We're talking about a broker-dealer. So, boy, you really want to get good at saying, oh, wait, am I being asked about an investment advisor or a broker-dealer? Because they're going to be different. Who is also registered in Illinois. If his previous employer fails to notify the state administrator of the termination, the agent would notify the administrator of his termination, right? That's called a U5. So U4 is hello, U5 is goodbye. So, we're going to file a U5 with the broker-dealer A, an amended U4 with broker-dealer B. I'm going to get a copy of it, of the U5. So this means I can, interact with the administrator to tell, no, here's a copy of my U5. So notify. Which of the following may not open a joint account? This comes up over and over again, right? Minors, we don't open accounts for minors directly. Remember, the minor, to open an account for the minor directly, it has to be an UTMA account. You're going to get a couple questions on minors. Remember, minors are not persons under the Uniform Securities Act. And the way we invest with minors is through the Uniform Transfer Minors Act, one minor, one custodian per account. And we said that no margin. All of that is very testable. It would not be considered passive real estate investing. So it looks like A is passive because you're not managing the REIT. Common stock, you're not managing ABC. Hybrid REIT, you're not managing it. You're buying homes and flipping them. That's not passive. That means you're actually doing that. You're actively involved in that. The SEC requires that reporting companies, those are called public companies, file certain information with specified time limits. Which of the following carries the shortest time limit? An 8K is for a material current event. So your CEO resigns, or I just read where, was it KFC? Yeah, which is part of Yum Brands. They had a change in their pension plan, and they lost, like, because of the difference in the payouts, they lost like 3 senior people, been there for 20, 30 years. That's going to be the 8K. The quarterly reports are the 10Qs. The annual report is the 10K. And so it's an 8K. It's a material current event. You can also use an 8K to correct a violation of Reg FD. Client's bond duration is the fancy word for volatility. Now, they're not on the test going to have to calculate duration. You're just going to get shown some bonds, And then you have to, pick which bonds would have the highest duration. It would be long and low, long and low. You'd go shop the answer set, and then you would pick the bond that has the lowest coupon and the longest maturity. Go maturity first, lowest coupon, you'd say it has the highest duration. Here, they're just asking you to take the average. So, I told you might have to do a simple average here, and you would simply total these up and divide, and you would come up with the answer. I told you I'm trying to bring this in some timely fashion. So I'm not going to do that. Let's see if I can do it real quick. Maybe I'm lying. 4 and 5 is 9, and 18, 25, and 15 years. So 5 durations divided by 5. So 40 divided by 5. I think I do it quickly. Who knows? I may get that wrong, but we're trying to get in and out of this practice exam in some reasonable amount of time. A client is covered by a non-contributory pension plan. So that means you don't have to put any money into this thing. Non-contributory. Contributory would mean where the employee has to contribute something for their retirement. So that's what that means in plain English. As terminated and takes a lump sum. So you leave and you take the money. Which of the following actions should the customer take? Well, unless you want to pay taxes on the distribution, I would highly recommend you roll it over into an IRA within 60 days. I would know rollovers need to take place within 60 days. That's testable. That's testable. What else would I know about this? Yeah, I think that's pretty much it. The difference between a fixed annuity is not a security. A fixed annuity is a traditional insurance product. A variable annuity is a mutual fund with an insurance wrapper. A mutual fund with an insurance wrapper. We refer to these as non-qualified retirement plans. I would expect you to get a question or two about variable annuities. They offer a payment that may vary. Offer guaranteed return? No, you don't use the word guarantee. That would be fixed annuity. I need something without one. So that means I'm taking 2. Offers a payment that may vary in amount. Yep. 3, always pay out more money than the fixed annuity. We don't know that because you have investment risk. Yeah, they have more inflation protection than the fixed annuity. I don't like that, but better than a fixed annuity. Not better than common stock, but 2 and 4. Managers of bond portfolios who anticipate an increase in interest rates, right? So remember, when interest rates go up, bonds go down. Assume a higher risk in the secondary market. Yeah, that sounds pretty good, right? I mean, if you're going to sell your bonds and the interest rates have been rising, you're going to get a lower price for them. Let's see what our other answers are. Should decrease the portfolio's duration. That sounds pretty good. You can choose not to participate in the secondary market. But remember, duration is a function of maturity. So if you think interest rates are going to go up, you would reduce your exposure to longer term bonds. And by doing so, that would decrease the volatility. As I said, the fancy word for that is duration. So again, just a fancy word for duration is volatility. Duration is fancy word for volatility. And you should just know that, again, longer term bonds with lower coupons have a higher volatility, therefore they have higher duration. And then all investing carries risk of loss. Yeah. Some positions have much higher risk than others. Among the riskiest is selling stock short. Which of the following types of orders would you recommend to a short seller as a potential hedge against loss? I would recommend either buying a call contract, a choice to buy back the borrowed stock at a set price at any time between now and some future date, or a buy stop. Tell my broker if it trades at or through a certain price, buy back the borrowed stock, give it back to the person I borrowed it from, and send me home. Send me home. You're going to get a couple questions on types of orders. If this was a long stock position, it would be a sell stop. Limit orders aren't used as hedge. Limit orders are to get your price or better. A benefit of an active investment in real estate that is not available to a purchaser of a REIT. So they're asking, why would you want to go do the real estate yourself rather than using this package product called a REIT? One of the major advantages in real estate is, when you sell a piece of real estate, you can roll it over into another piece of real estate, exchange it, do a 1031 exchange and avoid taxation. I haven't had anybody on debrief tell me they've ever seen a question about 1031 exchanges on 65. A grantor retained annuity trust is a planning tool used to pass assets to the beneficiaries, usually children, in a way to minimize taxes. So you are going to get a couple test questions on trust accounts. And this one is to minimize estate taxes because trusts are about, people dying. Right? That's a pretty mellow version of that question on your test. An individual with $100,000 to invest requires the funds in 6 months to purchase a house. We told you that this is very much a test question, this thing about somebody having a very short time horizon and what would or would you not do. The last question was, I didn't think very suitable, but the guy put it into an ETF. If I were your compliance officer, I would have frowned on that. So did the agency act correctly? I told you to put it in an IPO. Oh my God, no. I told you to put it in a partnership. Oh no, no liquidity. High risk, high reward in an IPO. IPO stands for instant profit opportunity. No, I'm joking. Stands for initial public offering. Lump sum annuity. Absolutely not. I'm looking for a money market. You're going to get tested on money market securities, high quality debt, maturing in 12 months or less. Very testable. A margin account that contains both long and short is known as a mixed margin account. Again, 65 can be a challenge. I'm not sure how much time you want to spend on margin accounts. And in contrast to a typical forwards contract. So I like this. I told you I've been thinking about it. This is our third question on futures on the 65. There's our, I guess we're at 90 minutes. Oh God, these things are long. But my channel is known for longer form content. So what can I tell you? This will probably get 2 views. So, but I told you people do like to have this. Will be, I think, the third practice final that is available to you on the 65 playlist. Anyways, in contrast with typical forwards, this is very much a test question. Futures contracts have standardized terms. That's a neat thing, right? So forwards contract does not. If I'm like, a grain elevator and you're going to deliver grain to me, you have the risk that I can't pay you, and I have the risk, what kind of grain are you delivering to me? We both have contraparty risk, so that's no good. So one of the reasons you might want to do this in the futures market is the contracts are standardized. There's an issuer, there's a guarantor, you have less contraparty risk. By the way, the opposite answers, right? They have more, for futures have more liquidity. They have less contraparty risk. And, B, C, and D are all the bad things about a forwards contract. So I would be able to contrast forwards with futures there, and that's one of the contrasting points. Under the National Securities Market Improvement Act, the term federally covered advisors. So National Securities Market Improvement Act created 2 buckets of federally covered things: federally covered investment advisors and federally covered securities. And state administrators weren't big fans of it because it took power away from them. And it said that, you can register with the SEC if you have 100 million or more in assets of management, your choice. At 100 million or more, 110, you belong to the feds. So it includes a person. Remember, this is a non-natural person, unnatural. This is the firm. Registered with the SEC. Yep. Registered as an investment advisor in 2 states or more states. No. There is where you can become federally covered based on the number of states. It's way north of 2. Excluded from the definition of investment advisor under the Investment Advisor Act of 1940. So required to register with state administrator. You should have been able to do this with process of elimination. I don't like 3, but you should know you're never going to be a federally covered advisor in state. It's one or the other. So I should know 1 without 4. 1 without 4, which means I'm going to have to take choice C, even though I don't like Roman numeral 3. But, being a test taker, sometimes you got to do what you got to do. A client owns an investment grade bond with a coupon of 7. If similarly rated bonds are issued with a coupon of 5 and the market is efficient, it would be expected that the client's bond would be selling at. So again, they're getting at this idea of whether there's a, price discrepancy, a value, is it undervalued or overvalued? And, we had one before where it was neither overvalued or undervalued in terms of the question, right? So this is now a same kind of a version of that test. And remember, when it is going to be highly efficient, it's going to have 0. It's neither going to be undervalued or undervalued in terms of the net present value. So the answer is B. An investment advisor rep has a client who prefers the safety of securities guaranteed by the U.S. government, is concerned about volatility due to uncertainties and the future direction of interest rates. Which of the following recommendations would best address this? So this is asking you to go the opposite direction, and have shorter duration or less volatility. So this is kind of the opposite question. Be careful when you get the opposite, because it'd be really easy to miss this, right? So which of the following would best address this concern? So we're looking here. When investment advisor represents a client who prefers safety of securities and is concerned about volatility due to uncertainty, which would best address it? So we should be able to get rid of the strip, right? The strip, because that has no income stream, so it'll be more volatile. So C is out. We know that the income should act as a stabilizer on the price. So again, the lowest coupon down is going further. So it's the opposite. So I'm going to want the bond with the highest coupon, because that'll be more stable than the others. The lower coupons are going to be more volatile. The advantage of structuring a business operation as S Corp than a C Corp would be very much, again, you're going to get some question on these business structures and how they're different. Remember, the C Corp, there is going to be double taxation because the corporation makes money, pays taxes, and then, you get your dividend and you pay taxes. That money has been taxed twice, right? So the S Corp, it's going to have a flow through. You're going to avoid that double taxation. The C Corp can have unlimited number of shareholders, so B is wrong. C Corps have limited liability, simplicity, no. When capital to a public, no. S Corp would be very hard for an S Corp to go public. It's A. Again, you're going to get at least 1 or 2, 3 questions on business structures. A state registered investment advisor, we said you're one or the other. You're one or the other. And we say that we use Form ADV, Part 2, as a brochure. So use Part 2 of the form to satisfy the brochure requirement. That sounds awful good. Part 1, no. Annual delivery, that's not 150, it's 120. No, 48 hours is about the 5-day free look, so the answer is A. An investor goes short 5 soybean futures, so I want them to go down. Good news, they're on the Merck, so I don't have to worry about a soybean grain elevator or soybean farmer. When the contract expires, so it's kind of, derivatives, they're kind of like options. They're, similar, but they're also kind of different. I wouldn't worry about this idea of when they expire. But, unlike options, you're obligated to perform on the contract. I don't think you need to worry about this one as it relates to futures. Dollar cost averaging is very testable. What makes it work? Fixed dollars invested regularly. What's the end result? Lower average cost of the underlying shares. And you can't guarantee a profit. So an investor would be putting the same amount of money in each month. I'm just checking my answer set. Remember RTFA? No, the whole point of D, remember, the whole point of this, you're going to buy more shares when they're low and less shares when they're high, which you should be doing. So you're not going to get the same number of shares. All following the interest, except you should definitely know that Ginnie Mae's is the only investment vehicle that pays interest and principal monthly. So it's C, Ginnie Mae's, very testable. You should know they're fully taxable, and you should know they're guaranteed by the United States government. Which of these is an advantage of using the cover debt? I hate this because on the test, it's the opposite question. You need to tell me why you would want to use a 529 instead of a Coverdell. But Coverdales do indeed have more investment flexibility with what you can do with the money than a 529. Which of the following has the least exposure To inflationary risk, you should know our best hedge is common stock historically, not over the short term, but over the longer term, common stock. I would also know tips. Don't beat inflation, but Treasury inflation protected securities will keep pace with inflation. So that's very much a test question, very much a test question. Prosperity Asset Partners is organized as a general partner. PAP is registered in 4 states. All the following statements are true about the investment advisor brochure, except, boy, you got to be real careful on these except questions. Real careful. By the way, these QBank questions are coming from the same that you would have in your QBank. And I'm just recalling that I got into it with the person on this question. This one is really obtuse. So I happen to know, because I was talking to such a matter expert about how unfair I think this question is. So the key to this question is it's general partnership, right? The disclosure assurance must be signed by an officer or a general partner. There wouldn't be officers. Partnerships do not have officers. So I happen to know that this is the except. Now, really on these except formats questions, what you really want to take away is the truthful things, right? So B, C, and D are all truthful. The brochure rule permits advisors to deliver the disclosure brochure when the client enters the contract and is allowed to cancel within 5 business days. Very testable, very true. By the way, that would be 48 hours if I didn't give it to you before there. The disclosure brochure must contain essentially the same information as found in Part 2A and about 2B. Indeed, very true, very testable. The disclosure brochure must be delivered no later than 40 hours before entering into the advisory contract, or there be no requirement of the 5-day refund. That's very testable and very true. So it's actually the takeaways from that question that's testable. The head of the research of your firm has just prepared a positive report on DEF Industries. The report will be placed on the firm's website later today, and copies will be made sent to the customers, emailed to the customers for whom it's deemed appropriate. Tonight, this analyst will be appearing on CNBC and be describing why he has issued the strong buy recommendation. As an investment advisor representative, you would not be permitted to contact your clients until there was ascertained that the report was general public knowledge. Yes. Otherwise, right, you would have information that not available to the general public. That would be material non-public information. Nope. So it says you call them right now. Hey, got a live one for you. No. So yeah, not permitted until it's, the definition of material non-public, right? So once it's public, then it's not, material non-public. It's material, but it's not perhaps public. Which of the following is charged with the responsibility of enforcing the code? So, the code of ethics. We said unethical behavior is very testable and on the test. So now they're asking you who is going to enforce this. Well, remember, you're not going to hear from the SEC until after the fact, right? So I think your chief compliance officer, is going to be supervising the IARs. The administrator, no, the SEC, B and D don't come into play until after somebody's in trouble. So it's going to be your chief, compliance officer. Which of the following are defined as securities under the Uniform Securities Act? So, again, some things are securities, some things are not. The one on the test they always like to ask about recognizing as not a security is precious metals. But, remember, if it's a security, then we have to go into this idea of do we need to register it? And REITs, certificates, are evidence. That's a security. Pre-organization subscription agreement. Remember, no more than 10 subscribers with no funds paid in is a security. It's an exempt transaction, but it's a security. Treasury stock is securities. A voting trust certificate undergoing a reorg. This is in bankruptcy. 1, 2, 3, and 4. I wouldn't really worry about that too much on the test. The big deal on the test is going to be once it's a security, is an exempt security, a noun, list that doesn't even register, or is it an exempt transaction? And then if it isn't an exempt security or exempt transaction, How are we going to register it? Through coordination or qualification? A client wishes to have $50,000 available to help a college, 3-year college in 15 years. So it looks like we're looking for the future value of this money, right? Because we need $50,000 at some future date. So that's going to be important, in terms of answering this kind of a question. Your client, you estimate you're going to need 7% return, and a deposit of $18,000 will be required today. So the deposit is referred to. So the future value is $50,000. That's the future value. The $18,000 today is the present value. And the 7% is the return that will take the present value of $18,122.30 to the future value of $50,000. Remember what we said here? We're going to go long and low. Long and low. So we're going to go first to the bond with the longest maturity. That's bond C with the lowest coupon. So it looks like C. The Conference Board releases information on the economy on a monthly basis. Included are a number of different indicators. The ones you're going to get tested on the test are leading economic indicators, and stock prices are all about earnings or future expectations of earnings. Leading, lagging, coincidental. Leading tells where we're going, lagging tells us where we've been, coincidental is where we're at, which indicates the timing of their changes relative to the economy as a whole. Which of the following is lagging economic indicator? Well, new orders, building permits, that's going to be leading. Employment is going to be coincidental. I wouldn't worry about this at all. I would definitely know that 2 calendar quarters of declining GDP describes a recession. I would definitely know stock prices are a leading economic indicator. I would know 6 calendar quarters of declining GDP is a depression. Which form you are going to get tested on the efficient market hypothesis? Yeah, the one that shows up on the test is the strong form, where nothing works, where nothing works. So when investors which form of efficient market suggests the fundamental analysis and insider information may produce above market returns? So, with random walk would mean nothing works. That's the strongest form. Semi-strong means material non-public information works, or strong. Some people disagree about that. But this would be the weak form. Weak form is where we say that some things do beat the market. Some things do beat the market, right? Fundamental analysis would be Mr. Buffett. Weak form would make the exception that he's, gee, what is he, a statistical anomaly? Because if you believe in strong form, he wouldn't be able to beat the market. As I told you, the test will have a question on this, and they're going to ask you about the strong form. Dark pools of liquidity. So institutional investors, sometimes in the fourth market, trading amongst themselves, like to remain anonymous. And that's what we mean by a dark pool, where the buyers and sellers remain anonymous. Insiders can trade without being recognized. No. Market transparency is reduced. No. C, there you go, D. C is in Charlie. Institutional traders are able to execute large block trades without impacting the public marketplace. By the way, that's called fourth market, direct trading between institutions. They don't all trade in dark pools, but sometimes they like to use the dark pool so they can remain anonymous. 2 plus 20 has equal probabilities of a 10% loss or a 30% gain. The probable return, as I told you, in the interest of getting this done in a timely fashion, I'm just going to guess B and assign it to the universe. I'm not going to do the math. I don't think you're going to have to do the math. Core inflation is best described as, so core inflation, we say some things are too volatile to be put into the CPI, the Consumer Price Index. And so, you should definitely know the Consumer Price Index is what we use to measure inflation. You should definitely know that TIPS, the principal value, will be adjusted semi-annually for inflation. And the whole point of core inflation is to toss out volatile things like food and energy. So the answer would be it excludes volatile goods prices. The Uniform Securities Act authorizes the state administrator to require, you won't get but 2 or 3 of these multiples. The test prep vendors like Kaplan use a lot more of the multiple format than you're actually going to encounter on your exam. So the state administrator one can either have oral written qualification examinations of an investment advisor, representatives, and officers. Yes, that's true. Officers of investment advisors need to pass a qualification exam. Shouldn't be struggling with that. It's called a 65. Yes. An applicant for initial registration to publish an announcement to, they can put in the public, the state administrator public paper. So maybe there's somebody out there that doesn't know you're getting an investment advisory business and you ripped them off or something. 3 is true. Investments have to, but you have to take a 65. So 1, 2, 3, 4. Balance sheet is, I would definitely know the classical balance sheet equation, which is assets minus liabilities equals net worth. Definitely would know that. I told you I would know some of the liquidity ratios on the balance sheet. And so the balance sheet contains gross revenues. No, that's going to be the income statement. Balance sheet is a picture in time. B, the net worth. Yeah, that's definitely going to be on there, right? Assets minus liabilities. I would know the theoretical liquidation value that we can calculate for the balance sheet. It's called book value, right? So, nope. I'm just looking at the other answer sets. Other answers. Which of the following statements regarding foreign investing is true? Foreign financial markets are more efficient than the U.S. market. Most foreign investment entails foreign exchange or currency risk. That's true. We need 2. 2 without 1. So now it's either B or C. Adding foreign securities to a portfolio provides the greatest diversification. When the foreign stock market has a 1 correlation relative to the U.S. market. I don't like that, but the whole point of adding it to the portfolio is to get different correlation with the U.S. market. However, 4 says that foreign securities markets are more highly regulated. I know that is definitely not true. A lot of foreign markets, they say, listen, you work damn hard to be an insider. What's the point if you can't profit from that? So based on this answer set, I'm going to go with my 2 only, because remember, to say it has a correlation of 1 means that it moves the same as the U.S. market. So that wouldn't typically be true, but if it is, then I haven't accomplished anything in terms of diversification. So I'm going to go for 2 only. An investor in an equity security acquires ownership interest. Yep. Corporations are capitalized with equity and debt. Equity comes before debt. Creditor, no, that would be buying the bonds. No, you don't have a say to say on the day-to-day. You're assured a minimum rate? No. So you're an owner. You're an owner of the company. Under the Uniform Securities Act, the definition of a broker-dealer, you should definitely know the definition of a broker-dealer. All these cast of characters in the play that you're taking, there's a cast here. A person in the business of making trades for their own account and the accounts of others. Yeah. Trades for their own account. They act in their dealer principal capacity, charge a markup or markdown, or the accounts of others. They act in their broker agency capacity and charge commission. Absolutely. That sounds like a definition of a broker-dealer. Let's see what our other ones are. An agent? Nope. You're the agent. You're an agent. That's not the broker-dealer. A representative? No. A trust company. Now, trust companies kind of look like broker-dealers, but they transact, but they're doing it for no money. They don't charge commissions for transactions, markups, or markdowns. So trusted companies, remember, are fiduciaries. Growth companies have all the following characteristics except high earnings retention ratio. Yeah, they're going to keep a bigger portion of their earnings because they needed to build the business. So we would expect to have little or low, no dividend payout ratio or little. That's true. Potential investment return from capital gains. Yeah. You only can make money from income stream and or price appreciation. We just said there's a little or no income stream. So that means price appreciation. And I know you're going to have to pay a higher PE. You are going to get a question like that. I would also know you can't use discounted cash flow to value a company that does not have a dividend. So, dividend discount model would be used for companies that are mature and stable and have a dividend that's reliable. And then we have the dividend growth model, which cannot be used for a preferred stock. Dividend growth would be the same idea, but I think the dividend could grow. One of the current concerns about social media is affinity fraud. So affinity fraud is like, I was in the Marine Corps, and so I was going to rip off people. I think it would be easier to rip off my fellow brothers in the Marine Corps because I would know, about the Eagle, Globe, and Anchor, Semper Fi, or I'm a Mason. I know the secret handshakes. Boy, when one of these things go bad, man, it goes really bad, right? So it says one of the concerns of social media for affinity fraud. I just told you what affinity fraud means. Is fraudulent offers aimed at groups of people who share similar interests. Yeah. As a compliance officer, you want to keep an eye on that, right? There's nothing wrong with having a legitimate business within your affinity group. The problem would be is if you're using that to take advantage of people. A client of an investment advisor needs a bridge loan, approaches the IA. The firm is interested. Here's Johnny Depp. Johnny Depp took out a loan from his investment advisory firm. Because the investment advisory is not in the business of lending money, a special agreement is drawn up specifying the terms of the loan. Under NASA's model rule dealing with unethical business practices, we said that model rule is very, very testable. The loan could only be made after the investment advisory contract was terminated. That would eliminate the conflict of interest, right? So the investment advisory firm says to Johnny Depp, we know you're unhappy. You have at the present time no money for us to manage anyways. So let's terminate that relationship and we'll front you based on, the next set of movies you're making. So, hey. What's the following? I told you ADRs are very testable. Sorry about that. We got a new dog here at my place and he's going a little nuts on something. So I'm going to pause and see what's going on. Okay, so I got Sawyer back in his kennel. So let's see if that solves our dog problem. Which of the following statements regarding ADRs is true? They facilitate U.S. trading of foreign securities. Very testable. We did this earlier. This is on the test. So we need Roman number 1. The dividends are received in the foreign currency? No. So we need 1 without 2. Holders have foreign currency risk. That's indeed true. This is very much on the test. It's 1 and 3. A client has a more than average aversion to risk with a primary investment objective of capital preservation. Given the following choices of portfolio allocations, which would probably be most suitable for this investor? I get these wrong all the time because these things are judgment, and I have I'm prejudiced. I think you should be probably fully equitized until you die, but not what the test is looking for. So it looks like based on this, what I'm probably going to have is a mix of investment grade bonds because capital preservation and cash equivalents. Yeah. All right. So that was A. Most interest rates are sensitive. You should definitely know utility stocks are said to trade on equity. They have a small amount of equity, large amount of debt. So that debt would mean they're interest rate sensitive, and preferred stocks for sure. So 1 and 3. What offering document of a fund states the minimum initial investment is $500,000? Ooh, certainly not a mutual fund. Sounds like a hedge fund. Remember, only offered to accredited investors. The writer of a call option has the right to sell? No. Pays the premium? No. Obligated to buy? No, that would be a put. It receives the premium. Again, you should know the 2 types of contracts, calls and puts, and you can buy or sell them. No place of business in the state would be considered a broker-dealer if he effects transaction in the state exclusively all the following except. You got to be careful on the except questions, right? Would be in the state all the following except. So remember, it's about retail clients. It looks like a little glitch here because, I had to deal with the dog. I'll maybe go back and see how messed up it is. But investment advisor, except investment advisor. Other broker dealers would be exempt. Issuers that are in the state would be exempt, and insurance companies. So it's A. I wouldn't worry about that one too much, as I just want to go back real quick. The thing to worry about is, again, if I have no retail clients in the state and no place of business state, all my people are institutional, then I don't have to register. So I wouldn't worry about that particular question. Mr. Foster is retiring in 2 years and will need income, which the following mutual fund would most likely be least desirable. So least desirable is a special situation fund, because that's about buying a special situation. Like right now, there's a special situation with Twitter and whether or not it's going to be acquired by Elon. A special situation would have those kind of stocks in the portfolio. In investors in search of greater return, has a portfolio of overconcentrated speculative OTC stocks. It can best be reduced by, you can't buy broad-based puts. You can't on the penny stocks. There's no arbitrage opportunity. I think the best way to handle that is diversification. When describing the differences between an investment advisor and an investment advisor rep. So the differences between, okay. All right, so we're looking what the difference is. Both can exercise discretion. The discretionary authority is to your firm, but then you're the one who's going to exercise it. So one is something that's both, right? So one is not true. I eliminate one means I'm taking 2 and 3. 2 is true. Custody is done by the firm, not yourself. The firm is the one who's bonded. You may or may not be bonded. You become covered under the firm's bond. And minimum net worth, whereas you do not. That's true too, right? The 10 or 35 grand. So the answer is 2, 3, and 4. A registered investment advisor recommends a stock that we sold to his client in a principal transaction. That means I may have my dealer principal capacity. So as a minimum, we're going to have a disclosure requirement. Requires both written disclosure to and the consent of the client prior to the completion of the transaction. Consent, disclosure is always going to be a right answer. So now we just got to decide which one of these is the best right answer. And it's going to be A. That is very much a test question, right? Requires written disclosure and the consent prior to the completion of the trade. Very much a test question. Which of the following is considered passive? So passive means, remember, we're going to buy and we're just going to hold. You do get tested on bond strategies. The one that shows up on the test is laddering. It is not going to be the answer here. Barbell would be short-term and long-term, nothing in between. Bullet would have a maturity date where all the bonds come. So that's going to be called a buy and hold strategy, right? By the way, we just buy bonds, we never sell them. We'd be immune from fluctuating interest rates. Accounts receivable, accounts payable, it says liabilities. Accounts receivable are an asset. Mortgage payable is not a current liability, it's a long-term liability. Accounts payable, yeah. Remember, current liabilities are things you plan on paying in 12 months or less. And that's going to be very testable in terms of being able to do working capital, current ratio, and the quick ratio. Which of the following hedge funds is the least accurate characteristics? They're heavily regulated. No, that's not accurate. They buy and borrow funds, use derivatives. Yep. Yeah, absolute returns. Yeah, so it's A, right? They're not heavily regulated. The whole point of setting up a hedge fund is not to be regulated. Cumulative preferred stock, it pays 8%. So 8% is based on par. It's supposed to pay $8. It's cumulative, so it hasn't been paid in 2 previous years. So that means they're going to have to take care of the arrears before they pay a dividend to common. You have preferential treatment, very testable in 2 areas. The dividend and liquidation. Here it's the dividend, so that's 16 plus the current dividend, which would be 24. Which of the following statements is correct? 1. State registered investment advisors have custody are required to provide audited balance sheets. Yeah, remember, it's going to be the 35 grand. Absolutely. For an aggressive investor. So the aggressive investor is going to want to have the highest allocations possible to stocks. And that looks like it's going to be D. Well, here we go. The Howey decision. Right now, our SEC chairman is debating with cryptocurrency guys whether they're selling securities. Gary Gensler taught cryptocurrencies at MIT. So, this is a famous kind of a thing. So an investment of money in a common enterprise with the expectation of profit or loss. That's definitely the definition at C. I would remember that. I would make a flashcard for that. Because remember, what is not a security is easier to remember: precious metals, insurance policies, retirement plans. And the idea is, if I convince you it's security and it's not, you're going to be, potential for fraud is large. Woohoo! On the Investment Advisor Act of 1940, how much were to be kept at the end of the fiscal year? So broker dealers, the vast majority of broker dealer records are 3 years, but investment advisors, their record retention is different than broker dealers. It's 5 years. Very much a test question. Woohoo! Okay. Oop, I didn't answer 102. Now, last time I did a practice exam like this, and I explicated it. I went back and for some reason I lost it. So I'm just going to submit this and take the hit for 102. And that way I don't take the chance that I won't be able to close this out for us in this session. I apologize. It's a long session. I hope you made it to the end. If so, you can now have a score that gives you some correlation about how you're going to do on the 65. Not bad, not bad. It looks like I missed some. I think those are the ones I assigned to the universe by guessing B. And so let's see if they're the ones I assigned to the universe. Yeah, that's one I assigned to the universe. Maybe when I go back and timestamp this, I'll show you the math. I'm trying to bring this in a timely fashion. Uh-oh. I think I did what I just told you I accidentally didn't want to do. Oh, there we go. Okay, so there's one. Here's our second one that Dean missed. Whoop. Oh my goodness, how did I miss that one? I said 1 and 2. Which of the following statements correctly identifies the hedging strategy? I did think I said that one correctly and picked the wrong one. I said Mark should go buy the lumber futures and Teresa should sell the cotton futures. That's exactly what I said. So don't be Dean. I said that correctly and then I hit the wrong button. Good news. That shouldn't hopefully cause you to, miss the exam. But let's see what my next one is. So that's one I hit the wrong button on. Let's see. Here's another one I missed. Again, that's one where I hit the wrong button. I think I said that correctly, that we're both obligated to perform. So I think that's one I just hit the wrong button, but that's not good. Not bueno. So I got 2 misses from just not being a good test taker. Let's see. What's my next one I missed? I think I looked at that one already. I missed 2 in a row. Let's see. Again, I said that right. Fourth market. So I don't know. Oh, that's the one I didn't pick the button right. I just submitted. So I got that right. But I didn't fill in the answer. Let's see what other one I missed. That was 108, I think. We had 2 in a row I missed, right? And I missed 103. Yeah, that was when I assigned to the universe. When I go back and timestamp it, I'll show you the math on these ones. But again, you should give yourself permission to assign those to the universe, and hopefully you're operating from abundance and not scarcity. And you can see that if you get stuck on something, you don't want to spend the time on it, you can assign it to the universe. Okay, looks like our last one I missed was 129. I don't know how I missed that. I think I said that right, and I picked the wrong one, but make sure you know that definition. Management of what did I say, common expectation of profit. Oh, just a C is better. I'm not sure if I accidentally picked the B. Oh, B is correct. And B is not. No, the losses, I just hit the wrong button. Because remember, those profits and losses are stuck within the corporate shell. Okay, well, thanks for joining me on that very long journey. And remember, inch by inch, your 65 is a cinch, yard by yard. Your 65 is hard. I think there's a couple interruptions that were in the video, and I'll go back if you find them distracting. Let me know where that happened, where Sawyer kind of intervened and I had to go secure the dog. But I'll see you next time. And this should be the last test you need to take in your testing journey. So kudos on your initial victories in this final leg of your testing journey.